Hello and welcome. My name is Steve Benenti and I'm an attorney with Schwartz & Associates. I have with me my colleague Georgette King, our operations and IT specialist. And today we are presenting part 2 of our 3-part series on the TILA-RESPA integrated disclosures. Specifically, we will be providing an in-depth look at the loan estimate form. As I've said previously, the new integrated disclosures change many different aspects of a mortgage transaction, and today we hope to give you a better understanding of these changes in the context of the new initial disclosure form, the loan estimate. The agenda for today. First, we'll start with a brief recap of the rule, some of the timing requirements, some of the definitions. Then we'll move page by page through page 1, 2, and 3 of the loan estimate, and we'll finish with loan estimate revisions, how the timing requirements work for that, and then we'll be done. The CFPB believes the new disclosure forms will be easier to use and will improve consumer understanding of key loan terms, features, and risk factors. The CFPB also believes the new forms will aid industry compliance with the TILA and RESPA disclosure laws. The new forms were created to streamline the current disclosure documents and to give the consumer a more cohesive and uniform disclosure. Applicability. So when do we use these new forms? Well, is the application date on or after October 3rd, 2015? The previous date of August 1st, 2015 has now been pushed back to October 3rd, 2015, thankfully. Is the transaction a closed-end mortgage of a 1 to 4 family dwelling attached to real property? And finally, are you a creditor that makes more than 5 mortgage loans in a year? If you've answered yes to all 3 of these questions, then you will use the new forms. Now some exceptions. These are the transaction types that do not use the loan estimate or the closing disclosure. And to be clear, it isn't that you're just not required to use the new forms on these transactions. It's that you cannot use the new disclosures and you must use the old disclosure forms. The exceptions are home equity lines of credit, reverse mortgages, mobile home loans that are not attached to real property, certain housing assistance programs, junior liens on those, and finally creditors making 5 or fewer mortgage loans per year. So there's quite a few exceptions, and if you're doing any of these loan types or making 5 or fewer mortgages a year, then you will still use the old forms, which are the initial TIL, the GFE, the HUD-1, and the final TIL. Application. Receipt of these 6 pieces of information constitutes an application. The loan estimate must be delivered or placed in the mail within 3 business days of receiving an application. These 6 pieces are the borrower's name, borrower's monthly income, borrower's social security number, property address, estimated property value, estimated mortgage loan amount, and you'll notice now that the 7th category, any other information deemed necessary, has been removed. There are 2 different definitions of business day that pertain to the loan estimate. Thankfully, these 2 definitions are exactly the same that we currently use and are defined in the Mortgage Disclosure Improvement Act. First, the loan estimate must be provided to the borrower within 3 business days of application. Business day in this scenario is defined as a day on which the creditor's offices are open to the public for carrying out substantially all of its business functions. This is the same timing requirement that the initial Truth in Lending has. And here provided means delivered to the consumer or placed in the mail. Second, the loan estimate must be provided to the borrower 7 business days prior to consummation of the loan. Business day in this scenario is defined as any calendar day except Sundays and legal public holidays. And again, this is the same timing requirement that the initial TIL has. It's important to note the 7-day waiting period begins when the creditor delivers the loan estimate or places it in the mail, not when the consumer actually receives it or is considered to have received it. Now I'll turn it over to Georgette, who will begin with an in-depth look at page 1 of the loan estimate.
Thank you. Now let's talk about the loan estimate. The loan estimate combines the initial Truth in Lending and Good Faith estimate. It's 3 pages long. It must be provided within 3 business days of application. It must provide a good faith estimate of the closing cost and transaction terms anticipated for this loan. And the loan cannot close until 7 business days have elapsed since the delivery of the loan estimate. The loan estimate and the closing disclosure both are dynamic forms, and we're going to talk about that a little more as we move through each page of the document. Here we have a sample of page 1 of the loan estimate. At the very top is general information, and then we have loan terms, projected payments, and a cost at closing table. And down there at the very bottom there is a website reference to the CFPB's website for information regarding the closing disclosure and loan estimate. Now let's do a quick comparison of page 1 of our loan estimate against our current GFE. We're going to go more in depth on some of these sections on a few of the coming slides, so we'll stop there and look at them a little bit further. But let's start here with our lender's name here at the top. The next thing is the borrower and the property address. Rate lock expiration date. General loan terms covering loan amount and interest rates. Can these amounts change after closing? Do we have a prepayment penalty or a balloon payment? The estimated costs that the borrower will be required to pay at closing. And then there's a few items here on the loan estimate that were not on our GFE. Here's our projected payments table. This is very similar to what we see now on our Truth in Lending. And up here at the very top we have our product information. Here we are at the very top of page 1 of our loan estimate. You'll see that we have general information, the applicant's name and current address, the proposed property address, our sales price, loan term, the purpose of the loan, the product, the loan type, a loan ID number, and again rate lock information. Remember a minute ago I talked about these forms being dynamic. Both the loan estimate and the closing disclosure are dynamic. Our current GFE is a static form. It looks the same no matter what type of transaction you have. For the loan estimate, we have the ability to indicate sales price here on page 1. For transactions without a seller, there's an alternative version allowed, which would indicate the estimated property value. So you can see that these fields change based on the type of transaction. On page 1 of the loan estimate, we have to identify a loan purpose. Let's talk about the 4 types of loan purpose that can be reflected. And I'm going to give you a few examples of these on the next slide, but let's just briefly go through them and identify them. Purchase, this will be a loan that will be used to finance the property's acquisition. Refinance, for a loan that will be used for the refinance or payoff of an existing obligation against the property, even if the borrower is getting cash out. A construction loan will be used to finance the initial construction of the dwelling. And home equity, this loan will be used for any other purpose not described above. So basically you start at the top of the list and work your way down. If your loan doesn't meet the criteria for Purpose 1, you move down to Purpose 2. Let's move on to the next slide and we'll talk about a few examples I have. Here I have a few examples of loan purpose. Let's start with a Texas Home Equity or a 50A6. A Texas Home Equity will be classified as a refinance for purpose type if you're paying off an existing lien against the property. So that's very important. We've always referred to them as home equities, but for the purpose of the loan estimate, it will be a refinance if you're paying off any existing liens against the property. If there are no liens against the property, then it will be classified as a home equity loan. A one-time closing might actually be considered a purchase or a refinance or a construction loan. It depends on the scenario for the transaction. If the borrower has no vested interest in the land and the home has not been built, then this would be considered a purchase. The lender's financing the purchase of the land as well as the initial construction of the home. If the borrower is vested in title and has an existing lien against the land where the home will be built, this would be considered a refinance if the lender is paying off the existing lien against the land. And then last, if the borrower is vested in title and does not have any liens against the land where the home will be built, this would be considered a construction loan. So you can see the loan purpose can be quite confusing, but if you just start at the top of the list and work your way down and eliminate each one till you get to an appropriate selection, you should be able to determine the appropriate selection for your loan estimate. Now we're going to talk about the product that's reflected on page 1. Similar to what we saw for the loan purpose, we have two lists. The loan product requires two pieces of information if they apply. The first piece is for any payment feature that can change the periodic payment of the loan, such as a negative amortization or an interest-only feature. If the loan can be described with more than one of these descriptions, only the first one in the list is disclosed. We start at the top of the list, just like we did with the purpose, and we go down the list until we get to the feature that applies to our transaction. So if you had an interest only and a balloon payment, the only feature that would be reflected for product would be the interest only. And then the second piece of information is based on how the interest rate is applied to the transaction. We have adjustable rate, step rate, and fixed rate loans. I'm going to move on to the next slide and show you a few examples of how these would be reflected. Let's look at a few examples of how our product might be reflected on page 1 of the loan estimate. Our first sample is an adjustable rate loan with an introductory rate that's fixed for the first 5 years and then adjust every year starting in year 6. So we're going to reflect this as a 5-1 adjustable rate loan. Our second one is a fixed rate loan with only interest due for the first 5 years of the loan term. We're going to reflect this as a 5-year interest-only fixed rate. And last, an adjustable rate product with an introductory interest rate for 31 months that adjusts every year. And this is going to be reflected as a 2.58 1 year with a 1-year adjustable rate loan. And the regulation states if it's not a full year, then you have to show it with a number followed by the decimal of how the additional months calculates into that full year term. So it's a little bit different in the way they say it has to be shown. Now let's move down to the loan terms section on page 1 of our loan estimate. This is our general loan information, our loan amount, interest rate, and monthly principal and interest. But let's talk about a few of the formatting items that are required by the CFPB. The loan amount would normally be disclosed as an unrounded number, but the CFPB says that if it's a whole number, then the amount must be disclosed truncated at the decimal point. So you'll see here that we don't have a decimal point and then 2 zeros that would normally be reflected. And the same thing with an interest rate. If it's a whole number, then it's truncated at the decimal point. If it's an unrounded number, then it should be shown to 2 or 3 decimal places. Over or under can this amount increase after closing, you'll see that there are yes and no answers. These answers have to be bolded and in capital letters. And you'll see that the answers out beside those, they're required to be in a bullet point format. And you'll notice that key points in that answer are in bold as well. It must spell out the additional information regarding the maximum amounts and rates, the change frequencies and timing when they can change, and where you can find additional information such as the AIR table on page 2 that we see there under the interest rate. Now we're going to move down to the projected payments table. Again, let's talk about formatting here. We talked about the form being dynamic. And what I mean by that with this particular section is the CFPB allows up to 4 columns to be reflected in our projected payments table. But if you don't have all of the information to complete 4 columns, then you can only show the number of columns that apply. So if you had a standard fixed rate loan with no PMI, you would really only reflect 1 column on the projected payments table. You can't leave the other 3 columns blank. If it is an interest-only loan, you'll see that we have an only interest designation here in the first column. And then in the following columns, you'll see that we have a range of payments. So in years 6 through 8 on this adjustable rate loan, the minimum payment would be $1,028. But we also reflect the maximum that it could go up to based on the adjustable rate terms that were provided for this loan. And the max here would be $1,359. If you have a single payment in the column, you reflect dollars and cents like we have in column 1. But if a range of payment is reflected, you round those figures off to the nearest dollar and again truncate at the decimal point. On the mortgage insurance, you'll see in this particular sample, we have mortgage insurance in the first 3 columns. In the very last column, you'll see a dash. A dash is required if there is termination of mortgage insurance or escrows, if that applies, on the transaction. If, like on the following line for escrows, they never applied to the transaction, then all of the columns would reflect a 0 instead of the dash. So depending on whether it cuts off or whether they never applied, depends on how you have to reflect those items. Down here under estimated taxes, insurance, and assessments, you'll see that you have to indicate whether or not the property taxes or homeowner's insurance or any other estimated assessment items are in the escrow account. You have to reflect the estimated monthly amount for all of the items indicated, even if they're not being set up in the escrow account. So if we had homeowners association dues here as well, that monthly estimate would include that figure. And if you had more items here under other, you can reflect more than 1 item, but you would reflect just your first item description and then the words "and additional charges" after, if some of those are escrowed and some are not. For the answer to "in escrow," you would use the word "some." Let's move on to the next slide. Now let's move on to the next section. The last section on page 1 of the loan estimate, our cost at closing table. This table just reflects an estimate of the amount that the borrower will be required to bring to closing. These figures to complete this section are calculated on page 2 of the loan estimate and brought forward to this page. And then down there at the very bottom, again, we'll see that reference to the CFPB website that the borrowers can go to if they have any questions about the forms. Here we have another one of those dynamic features again. The cost at closing table that we were just looking at on the previous page, there's actually an alternate version allowed for this table. We have our standard table, cost at closing table for a purchase transaction, and then there's an alternative version that you can use for a transaction without a seller. One thing to remember, we talked about in our initial training, was that if the cost at closing table, the alternative version, is used on your loan estimate, then you also must use the alternative version of the calculating cash to close table that we're going to talk about in a few minutes on page 2. And if both of those are used on the loan estimate, they must be used on the closing disclosure as well. So now I'm going to turn this back over to Steve. He's going to cover page 2 with you.
Now on to page 2. The second page breaks down loan costs, other costs, and provides an estimate for cash required to close the loan. The second page also contains the adjustable payment table and adjustable interest rate table, if applicable. The regulations indicate these tables are only permitted to be shown if there are increases to the payment or interest rate after closing. In this particular scenario, the loan is a 5-3 adjustable rate loan with the first 5 years being interest only, so both tables apply in this scenario. If the loan were just an interest-only loan, the adjustable payments table would be the only one reflected on this page. If the tables do not apply to the loan, they should not be reflected at all. The forms are dynamic, and this is a common theme with the new forms, to only show certain tables or information if they apply to the loan. One major difference from the GFE is that the loan estimate is now an itemization of fees. The GFE provided a lump sum bundled total for each section. The loan estimate now provides a good faith itemization of each fee associated with the loan. The regulation is very strict regarding the way fees must be reflected. They must be alphabetized. Title company fees must be preceded with the word title dash. Each section is limited in the number of lines that can be reflected on the loan estimate, and figures are rounded to the nearest dollar and truncated at the decimal point. Now on to page 2. Here we have a side-by-side comparison of page 2 of the GFE and page 2 of the loan estimate. First, we see the two sections related to origination charges found at the top of both pages. Next, services the borrower cannot shop for. Then, services the borrower can shop for below that. You'll notice that the loan estimate contains only the fee name and amount, while the GFE has a lot of additional explanatory information before listing the fees. Next, we move from the loan costs column to the other costs column and find the taxes and other government fees section. Prepaids right below that. Then the initial escrow payment at closing section, followed by the other section, which will include the owner's title policy. Then in section J, we see the sum of the total loan costs from the first column and total other costs from the second column, along with any lender credits. Finally, the loan estimate now has a calculating cash to close table, along with the adjustable payments table and adjustable interest rate table, all appearing on page 2. As I stated before, the adjustable payments table and adjustable interest rate table will only appear if the loan product necessitates it. Now for a section-by-section breakdown. We start with origination charges. This section should include any fees the consumer will pay to the creditor and loan originator for originating the loan. The first item here, percentage of loan amount, points, fee, will always be reflected on the first line of this section, regardless of if it is actually being charged. If there are no points charged, the dollar amount should be left blank. The fee is defined as any amount paid by the consumer to the creditor to reduce the interest rate. Also note that only items paid by the consumer are reflected under origination charges. Compensation that will be paid by the creditor to the loan originator is not reflected on the loan estimate. This section permits a maximum of 13 items to be reflected. If the lender is collecting more than 13 items, disclose line 13 as additional charges and total the amount of all the additional items. An addendum itemizing additional charges may not be used for origination charges. And from a formatting perspective, all fees listed below points must be listed in alphabetical order. The fee amounts are rounded to the nearest whole dollar, with a sum of all figures reflected at the top of the section. And finally, you'll notice that there are no line numbers reflected on the loan estimate. Services you cannot shop for. This section should include fees paid by the consumer for settlement services for which the consumer cannot shop and are paid to parties other than the creditor or the mortgage broker. Examples would include Schwartz & Associates document preparation fee, appraisal fee, credit report fee, upfront mortgage insurance premiums, etc. Again, this section has a maximum of 13 items permitted, and if collecting more, disclose line 13 as additional charges and total the amount of all the additional items. An addendum itemizing additional charges is not acceptable in this section either. And again, all fees must be listed in alphabetical order, fee amounts rounded to the nearest whole dollar, and a sum of all figures reflected at the top of the section. Services you can shop for. This section includes fees paid by the consumer for settlement services for which the consumer can shop and are paid to parties other than the creditor or mortgage broker. Some examples include pest inspection fee, survey fee, and title fee. This section allows for a maximum of 14 items. If you are collecting more than 14 items, now there are actually 2 possible ways to disclose the additional items. The first option is to disclose line 14 as additional charges and total amount of all the additional items, just like we saw in the previous sections. The second option allows for the addition of an addendum itemizing additional charges for the services you can shop for section. If using this option, line 14 should be labeled with an appropriate reference, then an addendum is attached. Again here, fees must be alphabetized and amounts rounded to the nearest whole dollar, sum of all figures reflected at the top, and finally, any fee that is a component of title insurance or for conducting the closing must appear with title dash at the beginning of that item and alphabetized accordingly. You'll see in the example on the slide that the 4 title fees are alphabetized. Taxes and other government fees. There are only 2 items permitted to be reflected in this section, and these items are predefined as recording fees and other taxes and transfer taxes. The fee amounts are rounded to the nearest whole dollar. The sum is displayed at the top. If either fee is not being charged, the amount is left blank, but the fee description will remain on the form. Transfer taxes paid by the seller are not disclosed on the loan estimate, but will be disclosed on the closing disclosure. Prepaids. This section is an itemization of each item that will be paid in advance of the first scheduled payment. A maximum of 7 items are permitted in this section. The first 4 are predefined. They are homeowners insurance premium, mortgage insurance premium, prepaid interest, and property taxes. Fee amounts are rounded to the nearest whole dollar, the sum of all figures displayed at the top. The exception to this rule is the daily figure for the prepaid interest. The daily amount should be reflected as dollars and cents, but the total per diem amount is rounded to the nearest whole dollar. Each item being collected must include the applicable time period covered by the amount to be paid by the consumer. If any of the 4 predefined fees are not being charged, the amount is left blank, but the fee description will remain on the form. 3 additional items may be reflected in this section starting under the 4 predefined terms. The additional items must be alphabetized under the predefined terms, and each item being collected must include the applicable time period covered by the amount to be paid by the consumer. Initial escrow payments at closing. This section is an itemization of each item that will be placed into a reserve or escrow account and will be applied to a reoccurring periodic charge. A maximum of 8 items is permitted, and the first 3 items are predefined as homeowners insurance premium, mortgage insurance premium, and property taxes. Again, fee amounts rounded to the nearest whole dollar, with the sum of all figures reflected at the top of the section. Each item being collected must include the applicable amount per month and the number of months being paid by the consumer at closing. If any of the 3 predefined fees are not being charged, the amount is left blank, but the fee description will remain on the form. 5 additional items may be reflected in this section starting under the 3 predefined. The additional items must be alphabetized. Each item being collected must include the applicable amount per month, the number of months collected at closing, and the total amount to be paid by the consumer. Other. This section is an itemization of fees that the consumer is likely to pay at closing and the creditor is aware of at the time the loan estimate is issued. Fees here do not fit into any of the previous categories. A maximum of 5 fees is permitted to be shown here. The entire section can be left blank if there are no other fees being collected. As always, fee amounts rounded to the nearest whole dollar with the sum of all figures reflected at the top of the section. As in the previous sections, any fee that is a component of title insurance or for conducting the closing must appear with title dash label at the beginning of that item, and items disclosing any premiums paid for separate insurance, warranty, guarantee, or event coverage insurance must reflect a parenthetical description of optional at the end of the label. For example, title-owner's title policy optional. Another example would be credit life optional or home warranty optional. Section J, total closing costs, which includes lender credits. Section J is the sum total of closing costs and other costs. Lender credits should be reflected in this section as well. This is the amount of any payments from the creditor to the consumer that do not pay for a particular fee on the loan estimate and is disclosed as a negative number. If there are no lender credits, the amount should be left blank. Calculation of title insurance premiums. To calculate lender's title insurance, the full premium should be used without any adjustment that might be made for the simultaneous purchase of an owner's title insurance policy. The owner's policy cost should be disclosed in the other category, as we discussed earlier. To calculate the owner's title insurance premium, use the full owner's title insurance premium and add the simultaneous issuance premium for the lender's coverage. Then deduct the full premium for lender's coverage. For example, in calculating the lender's policy, the full premium is used, even in instances where there is a simultaneous purchase of an owner's title policy. The owner's title policy premium plus the lender's policy minus the lender's policy premium gives us the owner's title policy, and you can see those examples there. Calculating cash to close. The Calculating Cash to Close table provides a breakdown of the total amount of cash that must be provided by the consumer at closing. It adds together the total closing costs from J, closing costs financed, and the down payment, then subtracts the deposit, funds for borrower, and any seller credits and adjustments or other credits. This is the same calculation that we're currently used to and use today. Here, we see the differences that appear on the alternative version for transactions without a seller. This alternative version may be used, but is not mandatory. However, if it is used, then the alternative costs at closing table must also be used on the closing disclosure. Adjustable payments table and adjustable interest rate table. As I stated earlier, these tables appear dynamically based on the loan terms. If the table does not apply based on the loan terms, then it may not appear on the form. It cannot be left blank, crossed through, or marked not applicable. So if it applies, it must be there, and if it doesn't apply, it cannot be there. The adjustable payment table is disclosed when the principal and interest payment may change after closing, but not due to a change in the interest rate. An example is when a loan has interest-only payments. Adjustable interest rate table is disclosed when the loan's interest rate may increase after closing. An example is an adjustable rate loan. Each table may appear independently of one another, depending on the particular loan's features. Finally, I'm going to turn it over to Georgette to discuss page 3 of the loan estimate.
Thank you. And here we are at page 3 finally, the last page of the loan estimate. Page 3 covers additional information about this loans. We have a comparisons, other considerations, and a signature statement. Let's look at these more in depth on the following slides. Before we move on to look at some of the features on page 3, let's just do a quick comparison of our loan estimate with our current GFE. Really, there are no similarities on page 3 of the loan estimate with the current GFE. The current GFE allowed some spaces for the borrower to put information if they were shopping with other lenders about the different loans that were available to them. Page 3 of our loan estimate has some comparison section, but it talks about the interest rate and annual percentage rate of the loan. So now we'll move on and we'll look a little more in depth at each section of page 3 of our loan estimate. At the top of page 3, we have contact information. This is the contact information for the lender and the loan officer and any mortgage brokers that may apply on this transaction. The table must disclose the name and NMLS information or license ID number for the creditor, the mortgage broker, and the individual loan officer if they apply. The information, if it doesn't apply, can actually be left blank. The next section on page 3 is our comparisons table. You'll see the first line says in 5 years. This section discloses two pieces of information. The first is the total amount that the consumer will have paid in principal, interest, mortgage insurance, and loan costs through the end of the 60th month after the first payment. So you'll see the total here is $54,944. That's what the borrower will have paid during the first 5 years. The second line is the amount of principal paid through the end of that 60th month after the first payment. In this particular transaction, it was an interest-only loan, so our amount here is $0. They will have paid off $0 in principal since it's an interest-only loan over the first 5 years of this loan. The next thing is our annual percentage rate. This is pretty typical. It discloses the annual percentage rate over the life of the loan. And the last item is the total interest percentage, the TIP. This is a new field that the CFPB has added to the loan estimate and our closing disclosure. You'll see the percentage here is 81.18%. This amount is pretty high, and I think the borrowers are going to have a lot of questions about what that total is and where it comes from. Basically, this is the total amount of interest that the consumer will pay over the life of the loan. So if you take the total amount of interest through the life of the loan, remember this is just interest, and divide it by your loan amount, you'll get the TIP. In my sample here, I have a $50,000 interest over the life of the loan, and our loan amount is $100,000. So pretty simple here, but the TIP is 50% in our sample. The next section on page 3 of the loan estimate are other considerations. These are disclosure type statements to the borrower about features and items on their loan. I'm showing you the whole section. Here is how it would look, but I had to break it up on the next few slides into smaller sections so that we can discuss some of them individually. Okay, here we have the first 3 items from the other considerations section that we just saw in the previous slide. The first is an appraisal statement advising that the creditor may order an appraisal to determine the value of the property and may charge the consumer for that appraisal. It also states that the creditor will provide a copy of that appraisal to the consumer whether or not the loan closes. The next is an assumption statement, just indicating whether or not the loan can be assumed in the future if the property is sold. And then the last is a homeowner's insurance statement advising the consumer that homeowner's insurance is required and the consumer may choose the insurance provider for the loan. And here we have the next 3 items. The first is a late payment statement detailing any charges that may be imposed for a late payment on the property, either stated as a dollar amount or a percentage of the late payment, along with the number of days that trigger that late payment fee. There's a refinance statement indicating that refinance of the loan is not guaranteed and will depend on many other factors. And then last, the servicing statement explaining whether or not the creditor intends to service the loan or whether they will transfer it to another servicer. And here we have the last section of the loan estimate, the confirm receipt section. This is a signature statement that is reflected at the bottom of page 3. The consumer is not required to sign the loan estimate though. The creditor can add the confirm receipt statement and have the consumer sign it to acknowledge receipt of the form. But you need to remember that the consumer signing it does not indicate their intent to proceed. So you'll need to work out those procedures internally in your company to determine how you're going to determine that the borrower has indicated that they intend to proceed with the transaction. This section can actually be removed from the loan estimate, and if it is removed, then there has to be a loan acceptance statement that's added up in the other considerations section that states that you do not have to accept this loan just because you've received this form or signed a loan application. And I'm going to show you where that would go in our other considerations section here on the next slide. And here you'll see that loan acceptance statement right here under our late payment section that I was just talking about on the previous slide. This is the statement that indicates the borrower does not have to proceed with this loan just because they've received the form or signed a loan application. So that's it for our loan estimate. I'm going to turn it back over to Steve, and he's going to finish up with a few items. And I appreciate your time.
Now we'll talk about revisions to the loan estimate. Aside from the allowed variances, which we discussed in the previous webinar, the fees disclosed on the loan estimate are binding to the creditor. The creditor may not revise or reissue a loan estimate simply because they later discover technical errors, miscalculations, or underestimations. However, there are certain situations where the creditor is allowed to provide a revised loan estimate. These are change of circumstances that cause estimated settlement charges to increase, a change of circumstances that affect the consumer's eligibility for the terms applied for or the value of the property, revisions requested by the consumer, in instances where the interest rate was not locked when the loan estimate was provided, and locking the rate causes the points or lender credits to change, the consumer indicates intent to proceed more than 10 business days after the original loan estimate was issued, and finally, the delayed closing for a construction loan if the original loan estimate stated that at any time prior to 60 calendar days before consummation, the creditor may issue a revised disclosure. So, if based on the criteria shown in the previous slide, a creditor is permitted to issue a revised loan estimate, then it must be delivered to the borrower or placed in the mail no later than 3 business days after receiving the information resulting in a revised loan estimate. Here, business day is any day except Sunday or legal public holiday. Finally, there are timing restrictions on how many days prior to consummation a revised loan estimate may be provided. A revised loan estimate cannot be provided on the same day or after the date the closing disclosure has been provided to the consumer. Additionally, the creditor must ensure that the consumer receives the revised loan estimate no later than 4 business days prior to consummation. If the creditor is mailing the revised loan estimate, then it needs to be placed in the mail 7 business days prior to consummation to allow the 3 business days for receipt to elapse. This concludes our presentation. Thank you for listening, and we hope this was helpful in understanding some of the nuances of the loan estimate. Our contact information can be seen here. Please feel free to reach out to us with any questions or comments, and be sure to look at the resources on the CFPB's website. There's some really helpful ones up there. Our next presentation will be an in-depth look at the closing disclosure and will be available soon. Thank you.